Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. I want to thank everybody for joining us this week. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We are independent. We are a registered investment advisory firm. And yes, we are a fiduciary. Everything we do is to make sure that even in times of market stress, that we have something inside of our clients' portfolios that can protect principal or deliver positive returns, or both. That is the goal of an advisor. In my opinion, there's so much wrong with this industry. I think you've known that if you've listened to my show for any length of time. I am certainly going to share a lot with you today. If you have listened to the show in the past, welcome back. If you are a first-time listener, thank you. Where have you been? No, just kidding. We obviously really want to make sure, especially in times like we've experienced here recently, that we're bringing value to whoever listens to the show. We do know that there are a tremendous amount of listeners. That is something that I am very, very proud of. I think when we look at the podcast numbers and we look at how those numbers continue to increase long term, especially as I do the show, religiously every single week, those numbers continue to go up. And in times like this, when there is market stress, we generally see our phones start to pick up even more. And my job is to try to cut that cycle down. We don't want individuals to lose money or have market stress before they want to look at and identify if their portfolio is crafted as such that can deliver them what they expect, even in downtime. So if you want to have a conversation with us this week, 630-492-1912, 630-492-1912. Jenny or Paige will set that meeting up, and we'll have our initial call. Generally, that call is pretty high level. Learn a little bit about what you're doing and see if there's a good match on what we are doing, and then we will go from there. So one of the benefits of talking with individuals, not only current clients, but other individuals that are interviewing us to work with them, is I get to see many ideas, I get to see many thoughts, I get to see many portfolios, I get to see just a tremendous amount of information from the industry. And I don't know how many close friends I have in the industry, but there's probably 40 or 50 people that I could reach out to and just ask what's going on in their day. What are you doing? What are you doing different? Are you worried? What is the market telling you, et cetera, et cetera? So I have my finger on the pulse of the market, and more importantly, especially for this show, what is the advice that is being given to individual investors. And our client base can range from a few $100,000 to $20, $30 million kind of net worth clients. And so we really have made a conscious decision to help individuals really regardless of what they have. And I think that's just being good stewards of financial advice and us sharing it, because I think individuals need help no matter what. Now, the investments may be different because, the $5 to $10 million, $15 million client is, should at least, have additional strategies that the, $500,000 to $1 million client can't have access to. It's not our rule. I mean, I think that our rule is kind of archaic, that you have to be an accredited investor to invest in certain strategies. But unfortunately, it's not my rule. We just have to live by it, and it is what it is. But when it comes to, kind of where the market is today, it's very reassuring for individuals to know that they have something inside of their portfolio that can protect against market losses. And not only protect against market losses, but also have a strategy that can deliver positive returns in negative markets to a point. And we often talk a lot about that on the radio, and we do get a lot of, calls on that. The banknotes from, JP Morgan, Citi, Bank of America, Morgan Stanley, UBS, et cetera. These strategies exist. We did one, we do them probably every 7 to 10 days. But we had one a couple of weeks, well, not even a week back now, and it priced at 12.6. And so you get 12.6% as long as the indexes that bond, it is a bond. I mean, it's a corporate senior unsecured debt. So it is a bond. But as long as that index is not down, or indexes are not down 30%, you're able to still get your monthly coupon payment. So I really want you to stop and think, in periods of market stress, how great would it be to have something inside of your portfolio that, as long as the indexes that investment is tracking are not down 30%, that you're still making money. If you don't have that in your portfolio, and here's the beautiful thing about it, the minimums today are $1,000. $1,000. If you don't have that inside of your portfolio, you're not working with a cutting-edge advisor that is forward-thinking, that is forward-looking, that is using, I hesitate to say, the most proactive risk management strategies, because maybe that was proactive in the early 2000s. It's not proactive in 2025. It's just become more accessible. So if you want something inside of your portfolio that can still deliver positive returns, even in a negative market to a point, we really need to talk. 630-492-1912. Because, the markets can go down. I mean, that's not a news flash. I mean, the markets can absolutely go down. I'm worried about stagflation. I'm worried about high inflation. I'm worried about low growth. I mean, we don't have to go too far back to see a period of extreme market weakness. You go back to the early 2000s, just put yourself back in that. Most of you, probably driving around, today were either, well, I don't know where you were at that time, but I know where I was. And I had just gotten in the industry in the later part of the 90s, I think 96, 97. And then obviously we had, some great times. I mean, some crazy times and euphoric times. And then obviously with, the dot-com crash, I mean, that was a lot. And then think about this. And I know I say this a lot, but it took 14 years to get back to even if you bought Microsoft in 2000. So if you bought Microsoft in 2000, it took you 14 years just to get back to even. And what if we go through a period of time like that today? What if? Because an advisor doesn't know, I don't know, you don't know, nobody knows. And if you're listening to the talking heads, who comes on CNBC and talks, well, my belief is that people come on CNBC and talk their book. And whether they're long the market, short the market, that's what they're going to talk about. And so you have so many of these individuals, so many of these advisors just telling clients to sit and wait, don't worry about it. You have to take losses. The market ultimately over time goes up. Nobody is debating that the market doesn't go up over time. Of course it goes up over time. That's not even up for discussion. And when people talk about active management, they're like, well, you're trying to time the market, or you're trying to guess the market, or your crystal ball, why is your crystal ball better than, someone else's crystal ball? Well, the reality is we're not using crystal balls. You have got to make sure, especially in this market, because, things can spiral out of control very, very quickly. So one of our partners is on the younger side, mid-20s, absolutely phenomenal financial planner. I think the best that I've seen. He doesn't care about these markets. These markets to him are grab as much money as you can, invest as much money as you can. Don't worry about it. 3, 5, 7, 10 years from now, he's going to probably make 10x, 15x, 20x on his money. I mean, that's just, the way it works. But individuals who are in their 50s, who are in their 60s, who are near retirement, who are getting close to retirement, who just retired or are in retirement, what happens if the markets stay down for long periods of time? That's my concern. That is what we worry about. That is what keeps me up at night. That is what I don't think the industry has done a good enough job of explaining. the industry has gone to these asset allocated models, and 3 out of 4 years they may work. And when the markets are down 20 to 30 to 40%, what's the answer from your advisor? Well, sit and wait. Don't worry about it. You don't need the money. It's going to be fine. I mean, that to me is not an acceptable answer. That to me is a is a fireable offense. If an advisor says that to you, that the markets are very, obviously, the markets are going to do what the markets are going to do. But if we see continued market weakness, if we are down 10%, 15%, 20% for the year, which is absolutely positively a possibility. Probability, I don't know. I mean, nobody knows. I mean, it's crazy what's going on, but I do know growth is slowing. I do know that inflation is high, and I do know that interest rates are going to have a hard time coming down with inflation being where it's at. But if you reach out to somebody managing your money and you say, hey, what is our defensive strategy? What is our strategy to still be able to deliver some positive returns in down markets? If they can't answer that question, and bonds is not the answer, because bonds, they may go up, they may go down. And if you look at the correlation of bonds and the movement when, markets are weak, well, I mean, you're probably not going to be very happy with that. And so the industry has gone to these asset allocated models, and the advisors are absolutely doing nothing. They're just setting it and forgetting it and leading you to believe that there is active management, that there is proactive risk management, and that's an issue. And like I said early on this year, we are going to get very, very aggressive on that message, because the people that get hurt are those who can afford it the least. The individuals who are 10 years from retirement, 5 years from retirement, 2 years from retirement, just retired, in retirement, those are the individuals that cannot go through another period of significant market weakness or prolonged market weakness. And that is why we do the radio show. That is why we do the dinners. That is why we are very forthright in what we talk about when we meet with, because everybody who comes to us as a firm is working with a current advisor. I mean, and they're coming to us because of the proactive strategies that we use. They're coming to us because we could look at the protected growth bucket inside of our portfolio. Again, investing is protected growth plus, and then alternative tax reduction. That is the lens that you have to look at investing through. Growth, protected growth plus, alternative tax reduction. We want everyone to start to compartmentalize investments and compartmentalize strategies. Really look at it through that lens: bucket, sleeve, swim lanes. I don't care what you call it, but each of those strategies has a different focus, has a different return driver, has a different purpose of the portfolio. And you look at the protected growth bucket, people come to us a lot of times simply because of two buckets. They come to us because of the protected growth bucket and our tax strategy alternative bucket. And that protected growth bucket, part of that protected growth bucket is the bank notes that are issued by the largest banks. These are the largest banks' strategies. They are issuing them: JP Morgan, Citi, Bank of America, Morgan Stanley, UBS, etc. And when you can look at an investor and put inside of a portfolio a predefined outcome strategy, think about that: predefined outcome, meaning if this note is paying 12% and it is going to pay a coupon monthly, as long as the indexes, whatever that index is tracking, is not down 30%, you're getting paid your monthly coupon. So if the market is down 15, 20, 30%, as long as it doesn't breach that 30% barrier, you're getting paid your monthly coupon. So our clients, if the markets are down 20%, where everyone else, well, I don't know about everybody else, but 99% of investors are sitting there calling their advisor. The advisor's sitting there telling them, don't worry about it. You don't need the money. Market's fine. Markets go up. Markets go down, blah, blah, blah. I mean, if that is the case, why am I working with you first and foremost? That's what's always stuck out to me. What value are you bringing to the table? But anyways, that's, a topic for another day. But where we could look at a client and say, listen, 30% of your money, it still made 12% or whatever the note was. And it could be 15% of your money, could be 70% of your money. Who knows? But why don't you have those strategies in place? And it's almost like I just need to, sit outside, hire a bunch of people with signs and say, you can make money when the markets are down. And inevitably, most investors will say, wow, this is too good to be true. Well, it's not, unless you believe that the prospectus from JP Morgan, Citi, Bank of America, or whoever the note is that is issuing it, that they're lying, which obviously is not the case. And then the next question that we always hear is, why doesn't everybody do this? 630-492-1912. Set up some time to have a conversation with our team this week. 630-492-1912. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. Thank you for joining us. 630-492-1912, 630-492-1912. If you'd like to have a conversation with my team, we would be honored. We would love to share with you our strategies on how to protect principal and deliver positive returns even in negative markets to a point. So give us a call, 630-492-1912. So again, last week I said, current situation. Stocks are falling like the trade war is officially back. The U.S. dollar is falling like the trade war is over. Crypto is falling like the bear market has just started. Treasury yields are falling like rate cuts are back. Oil prices are falling like we've entered a recession. Gold is falling like we're on track for a soft landing. So if you look at the fear and greed index that we often follow, it is teetering between extreme fear and fear. And so, we have to make sure that, again, it's all about positioning. It's all about positioning your assets based upon where you're at in your investment life. If the markets are down and down significantly, personally, I wouldn't mind that, because that means that we have, if you have a lot of cash to invest, that means you're getting in at, a very, very good price. And you would like to think that over a year or two, you're going to be very, very rewarded for that investment. If you don't have cash to invest, well, you would hate to see a market crash. You would hate to see the markets just revert back to historical averages and see a 20 to 30% pullback. If you are nearing retirement, 1 to 2 to 3 years to retirement, and you see that kind of a big loss, you're going to have an issue, and it's not necessary. And that's what we want to make sure that we convey to individual investors. It's not necessary to sit and take losses. These asset allocated models, which almost everybody has, and and again, even if you have $15 million, I mean, there's a high likelihood that you have an asset allocated model. You have proprietary management, meaning the money managers are part of that firm, which, how are you going to fire those managers, right? How is the advisor going to fire those managers that are part of their firm? I mean, do you think about, well, you know what, we don't like our large cap growth manager, so let's just take this $1 billion, $500 million, $100 million, whatever that number is, and let's find a new growth manager. You don't think that they are getting a phone call, an email, a text saying, you can't do that, and what are you doing? So how objective is that advice? How objective is that advice if you are working with an advisory firm that has 100% proprietary management? It's unfortunate. And I've seen more and more people in the high net worth space that have 70% stocks, 30% bonds. And that's just, in my opinion, is a recipe for the unknown. It's a recipe not to be able to protect in times when protection is needed. It's a recipe to really have maximum uncertainty at a period of time if you're 5 to 10 years from retirement or in retirement that you just don't need it. Again, protected growth. What is your protected growth sleeve? What strategies do you have that can deliver positive returns even in down markets? What is your growth sleeve? What does your growth manager do? Does your growth manager just have a buy and hold mandate where you buy it and you hold it forever? Or does your growth manager have some sort of risk management that they can utilize cash strategically in periods of market weakness? I mean, it sounds like a novel idea, right? How many investors... I know this answer. And that's part of the radio show. Sometimes I ask these questions and it's like, well, you know the answer to the question because, I don't know, we can go down that rabbit hole, for days. But anyways, I want you to look at your portfolio in the growth and growth plus area and see how much cash do you have inside of your portfolio for the managers that are managing your money that are there now strategically to see and take advantage of, rather, a weakness in the market, a pullback in the market. And our Growth Plus manager, again, all third party. That's another thing that we have to really, really start to talk about is proprietary money management, because you just can't fire those managers. And if you have an advisor that is sitting there and allocating to managers that are owned by the firm, you are never going to have an unbiased, in my opinion, best of the best in class strategy, because the performance is all that matters. I mean, at the end of the day, that is all that matters is performance. And you can benchmark money managers, not advisors, because unfortunately advisors don't report into a clearinghouse that, says this advisor's good or that advisor's good. When clients ask us, for, performance, historical performance, all we can show legally is what our model that we would recommend has done. And again, it's past performance, and it's not a perfect comparison and shouldn't be taken as what your portfolio would be. It's basically just an idea that we have 4 distinctly different buckets. We have 4 distinctly different strategies. And if you use this strategy and you are in for this period of time, your returns would look something close to this. But you can't do that with advisors. So generally the best advisors who people think are the best advisors are those that have the best marketing, those that have the best outreach, those that can tell the best story. And there are money managers, and I can't name the firms, unfortunately, because, I already pay enough and I don't want to have to pay and just unnecessary, litigation fees of, other people and saying you slandered me, you talked, about my firm, and I can't do that. And at times in the past I've done it and I've learned my lesson. So we're not naming names of firms, but there are many, many firms in the Chicago area, those that advertise on the radio, those that advertise that you've seen national firms but have a heavy presence here, that hold themselves out to be better than everybody, that hold themselves out to we make more money as you make more money. When you look at fees, right, and you look at fee management, that is the pitch of every advisor. As you make money, we make money. Well, that is how the math works. There's no doubt about that. But as you lose money, they're still getting paid, right? And so this whole thing of as you make money, or I make more money, that all of a sudden means that you have, some really sophisticated proprietary strategy, but yet it's nothing more than the S&P 500. Now, you may own 50 names, you may own 80 names, you may own 150 names, but it's the S&P 500. We can run a quick correlation report to see the names that you own, how closely do they follow and track the S&P. And so you think you have this customization, you think you have this strategy that can protect in down markets, you think you have this strategy that is so cutting edge, but you really have 2 things. You have the S&P and you have bonds. I mean, that is not cutting edge. And we're in a period of market weakness. If we are in a period of market weakness today. That could change tomorrow, but today, as I sit here, as I look at the market today, that is a very accurate statement. So I want you to really think, what do you have inside of your portfolio that if the markets are down for 3 years, for 5 years, for 10 years, which again, statistically, that's been low, but you don't have to to go that far back in history to have had that happen. But if we were to do that, what do you have in your portfolio that can protect your principal, still make money? So people come to work with us really for two things. And I love our growth strategies. I think they're, well, second to none, in my opinion. Again, third party, all third party. So if they prove to, have changes in management, or they, continuously start to underperform the markets, we have no problems firing them. And that, to me, is a competitive advantage that I don't think I've talked enough about. Because if you're working with a firm, generally the bigger firms that, kind of $1 billion to $5 billion, billion to $15 billion, billion to $20 billion, they are going to hire they're going to have proprietary money managers, and they want that revenue. They want that extra, 0.3% or 0.25% or whatever that number is. They want to keep all of that revenue in house. And there's a huge, huge conflict of interest. And when the performance is subpar, benchmarked to the S&P, benchmarked to their peers, that's an issue. So, you have to make sure, again, that you have a manager that can fire the manager that is managing the money if they continue to underperform, if they don't deliver when the markets are down. So our so our tax strategy and our protected growth bucket are, two really attention getters as far as, when people work with us. And obviously the tax strategy, we haven't talked a lot about that today, but again, very simplistic, yet, in an industry that most people haven't had exposure to here in the Midwest in the energy space, we can reduce your taxable income greatly. Now, caveat to that, we're not tax professionals. Anything I talk about is for educational purposes only. Always reach out to a tax professional before you do anything in the tax space. It's simple. It's best practice. You just need to do it. But the tax strategies, the tax benefits of energy investing are clear. They are black and white, and they are significant. And so if you had invested in our fund, it is our fund, in 2023, you reduced your taxable income by almost $90,000 for every $100,000 you invested. So think about that. Active income, passive income, by almost $90,000 for every $100,000 you invested. And we target 70 to 90%. So 70 to 90,000 for every $100,000. So if you're a high wage earner, if you're a physician, attorney, doctor, somebody making $500,000, $1 million, $2 million, $3 million, $5 million a year, or you sold a business, you sold a property, you have significant capital gains, you have significant concentrated stock positions, let's talk about that. If you have IRAs and you want to do more Roth conversions, you don't need us for a Roth conversion. Where you need us is to reduce that taxable income to do that conversion. Those are the things that we are adding to the table. So now we're going to talk after the break about our growth strategies and our growth plus strategies and the competitive advantage that I see that those managers have in a market like this. 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Hopefully you know that by now. I do host this radio show. Hopefully you find value in the radio show, which is why you're either listening to it live or you're catching it on the podcast. My ask to you is if you find value, send the link on to somebody else who needs to listen to it. Again, these markets can get out of control very, very quickly. There is maximum uncertainty. Doesn't mean it's bad. Does not mean it's bad if you're positioned correctly to take advantage of it. And I do have to talk about that annuity story here in a minute, and I will do that this segment, I promise. But if you'd like to have a conversation with my team, it's really simple. Give Paige or Jenny a call, 630-492-1912, 630-492-1912, and set that up for this week, next week, whatever. We do have a busy end of March. We are starting our dinners that we generally start around this time of the year. Each year we'll go to sometime in around Thanksgiving. So we are looking forward to sharing the message. And the message that we share is you don't need to lose money. The message that we share is you don't need to Just simply sit and take a portfolio or a market rather that over the last month is down almost 10%. The message that we share is that there are strategies that can deliver positive returns even when the markets are down. The message that we share is you don't need to overpay in taxes if you use an investment that has significant tax benefits. I talked a little bit about our tax strategy at the end of last segment. I always like to spend a little bit of time on the show talking about that. It is an energy fund here in the Midwest. That is an investment that most individuals don't have. That is an investment that most advisors don't have a expert knowledge in. And you are missing out if you make what I would consider to be a good amount of money. So generally $500,000, $3 million a year. Or if you have a net worth not including your primary residence of $1 million. And if you have, what are the incomes? To be accredited, just Google accredited investor. And if you meet that criteria, again, it's not my criteria, it's the SEC's criteria, then you are able to invest in our energy strategy. And when you look at the benefits of the energy strategy, it's twofold. Number one, we are in the best oil field in the world in West Texas. That is where we are acquiring minority interests in the majors projects. So we are not drilling. We are simply acquiring in its simplest form pieces of the majors projects. And when I say majors, it's the Exxon, Chevrons, Conocos, Matadors, Mewbournes, Occidentals of the world. So the majors, they when you acquire land, generally when you have a drilling block, it's a grid, and then individuals don't acquire land in blocks. So there's always overlap of ownership. And so you have somebody generally that'll own 90%, 95%, 97% of that project, whether it's 10 wells, 30 wells, 50 wells, 8 wells, whatever. And it's generally in that location a major. When I say a major, you can look at them. You've heard of them. If you haven't heard of them, they're an industry leader. And you just do a quick Google search and you see how big they are. And they're the operators. The operators control everything. And what we are is we are acquiring the non-operated working interests of somebody who's selling. They want to probably monetize the investment. They can't come up with the money to participate in the drilling. And so we may have a 1% interest, 3% interest, 5% interest in the project. And when you can have a single fund that can have 100, 150 different wells with 8 to 10 different operators. Again, this is not If I Strike Oil. I mean, just Google the Permian Basin. You can see that. That's, if you've watched Landman, that's the Permian. And so what you get is significant taxable or tax advantage against your active or passive income. Again, please check with a CPA, a tax professional. We can't provide tax advice. I'm very clear on that. But the beautiful thing about these tax benefits is they have been around for decades and decades and decades. So what value, what competitive advantage do we have over almost every single advisor in the Midwest, certainly in the Chicago area? Well, we can bring to you strategies that can greatly reduce your taxable income. So when we talk a lot about Roth IRAs, you don't need us to do a Roth IRA. You know that. You can go and convert your IRA to a Roth, and that's simple to do. But can you convert your IRA to a Roth, take some taxable money, invest in this strategy, and mitigate some or all of that additional income that you're going to have for that conversion? Well, that's the question. And if you can't answer that with the current advisor that you're working with, is if you can't answer that yes and shake your head, he has that strategy. Well, it's our strategy, so I know other advisors don't have that. But if they can't do that, then we need to have a conversation. 630-492-1912. 630-492-1912. And the great thing about our tax strategy, which again, it could be 5% of someone's money, 10%, whatever. But the benefit is those returns, those distributions are coming in. If they are coming in, of course, that is it's an investment. But I don't think that the Exxon, Chevrons, Conocos, Occidentals of the world are going to invest 100 million, 200 million, 300 million, or whatever that is, $1 billion in a project unless they're very, very confident that they're going to get cash flow. But our cash flow is going to be paid regardless of what's going on in the market. And that is the beautiful thing that we have. Again, if you haven't learned by now, we look for investments to complement our current portfolio, our current strategies, with investments that can still generate returns independent of the market dropping, independent of what's going on in the stock and bond market. And that is why individuals reach out to us. We have a very, I guess it's cutting edge. Well, the energy strategy is not cutting edge at all. Again, it's been around. In the private equity space, you just don't need to write a $25 million check to get access to it. So again, it's not new. What's new is that somebody, that's accredited with a minimum net worth of, just Google the accreditation, income and net worth requirements, that you can get access to that for $100,000. That's what's new. That's what's unique. And so again, if you're making a bunch of money and you sold a business, sold a property, you want to pay less in taxes, you want to incorporate a tax strategy inside of your portfolio, let's talk about it. 630-492-1912, 630-492-1912. So we often talk about annuities, and we often talk about, we get tagged as, when we talk with people, that you don't like annuities, and that is a factually inaccurate statement. Part of our protected growth strategy is an annuity. It is a 5-year annuity that has no income. It's just a different annuity than what you've seen. It's a different annuity than what you're being sold. It's a annuity that, because these annuities pay commissions, right? And so when you have annuities that generally, unfortunately, many people who that is all that they do, which who they are on the radio. I don't need to call them out. Just listen to the radio shows and you can know exactly who is selling annuities. Now, they may package it up as, not an annuity, but as soon as you sit down with them, well, it's an annuity. It's the only thing we got. And this is why that you have to use it, blah, blah, blah. But so we're not against annuities. We're against the wrong annuity. And our 5-year annuity, it's really a structured note that is offered by an insurance company. And I say that because of how the hedging is. But think about this. Our protected growth bucket, so we have the bank notes that you're going to get positive returns, as long as you're going to get paid that coupon, as long as the indexes aren't down 30%. And then the second bucket of our protected growth strategy is that 5-year annuity, which currently is very simple. 100% principal protected, cannot lose money. Now, it's backed by the insurance company, of course, not FDIC insured. A-, super large company, tons of assets. I don't think we need to worry about that. But your worst year is 0. And you know what? It's tied to the S&P 500. That is what it is tied to, not one of these fictitious indexes that's never been around. It's, has 1 or 2 years worth of track record, but we're showing you 20 years of, back-tested data. It's tied to the S&P. And you get currently the first 10.25% of the S&P in an annual basis. Think about that. Market's down, you get nothing. Market's up, you get the first 10.25%. Now, it doesn't include dividends, so that is something that you absolutely positively need to know. But you get the first 10.25% of the S&P. And then when you get that gain is locked in. It's never going back. So you don't have to play that catch-up game. So tell me why that is a bad strategy. I will debate an advisor any day of the week on why everybody should have a piece of their money in that strategy. Again, you compare that to bonds over the last 5 years. Look at what bonds have done. Worst 5-year period in the bond market. Negative. You look at the 10-year bond strategy, any of them, pick them out. It's under 2%, annualized. 1.6, 1.7, 1.8% for your bond money. If you're using a bond, just you're benchmarking it to the Barclays Ag, under 2%. After inflation, after taxes, you're losing money. So again, when we look at protected growth, those are the two strategies. So here's the story on the annuity. So we had a potential investor call in. They're looking at $250,000, and somebody showed them an annuity that had guaranteed lifetime income. And hopefully you know what that means, right? The guaranteed lifetime income means you only take your own money out until the account goes to 0. When the account goes to 0, then you start getting into the insurance company's pockets. Problem with the annuity space is these illustrations. It is a major, major issue because these illustrations can say anything that we want them to say, basically. Well, I mean, you can cherry pick, you can show, performance that we know will never, ever, ever happen. But on paper, it's got that big company name, so it must have happened, right? They're showing performance data on indexes that weren't even around. So this was a $250,000 investment, and you give it to this, insurance person. They put it in this company, and then in, I think it was 3 years, in 3 years, it illustrated out that $250,000 investment was going to cash flow in 3 years, $50,000. Okay, so 20% or whatever that number is of the original investment. And that cash flow only went up every single year. And in 10 years, it was at $120,000. I mean, think about that. If a company could do that, would that company be in business? Not a chance. Sometimes you just have to use simple math, simple logic. I can't stand these annuity illustrations because they're showing things that are just will never, ever happen. So here's my suggestion. If you're being shown an annuity that shows these hypothetical growth situations, you have to look at no growth scenario. You have to look at, if there's no growth, what is my cash flow? When does my cash flow run out? I just encourage you, and I really want individuals to stop being sold these annuities based on these illustrations. So here's my offer to you. If you are being sold an annuity that you have an illustration, send it to me. We'll do a quick Zoom. We'll do a quick screen share. I'll just share my screen with you, and I will show you exactly the historical real live data of the performance versus what is being shown. I think it might open your eyes. 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Hopefully you know that if you're listening to this show, if you've caught this show in the past, if you're listening to the podcast, thank you. We are now on Saturdays and Sundays in the Chicago area, so hopefully you catch, it is the same show, but hopefully we're reaching a broader audience. Because, again, our message is to make sure that whether you have 100,000, 300,000, 5 million, 10 million, 30 million, that you have the most cutting-edge, proactive risk management strategy inside of a portfolio that can deliver at least principal protection for some of your assets or even gains in negative markets for some of your assets. Again, predefined. We don't talk enough about that, predefined. And we're going to talk a little bit about that here today. Well, sports segment, so hopefully we've talked a little bit about that throughout the show. But give Paige a call, 630, or Jenny, 630-492-1912, 630-492-1912. The banknote that we did last week, actually it was the week before, 12.6. So the annual coupon was 12.6, and it was BNP. You can Google BNP and look at their credit. Maybe the best credit out there. But again, it could be JP Morgan, could be Citi, could be Bank of America, could be Morgan Stanley, UBS. Who cares? I mean, who knows? I mean, when we do a banknote, it's a blind bid. And given that all of the banks have very similar credit, whoever comes back with the best yield, we obviously give them the business. So it paid 12.6% annually, paid monthly, as long as the indexes that investment tracked were not down 30%. And how would you feel if we're down 20% in the market this year, which is possible, maybe probable? Again, my crystal ball and your crystal ball don't really matter. Your advisor's crystal ball don't really matter, because so much of this industry is generally advisors aren't going to tell you what they really think. And generally they're investing their own money significantly different than they are investing client money. They're not using basic asset allocated models like they're sharing with you. They share that with you because it's scalable. They can raise a lot of money. They can get more in fees. I mean, come on. I mean, that's just unfortunately the way this industry is. You look at these target date funds, right? I cannot tell you how many people have been in target date funds that are 5 years from retirement, 10 years from retirement, in retirement, and have lost money. And their bond money has delivered absolutely no positive return, and in many instances, very, very negative returns. And it's just simply what happened with interest rates. So these strategies that are set it and forget it, well, they're great, absolutely phenomenal until they're not. And then once they're not, then you're left holding the bag. And it's the job of an advisor to be proactive, cutting edge, defined outcome. I want you to think about that word. If you don't have defined outcome strategies inside your portfolio, then you need to simply give me a call or someone else a call that utilizes them. 630-492-1912. What is a defined outcome strategy? Very simple. We know the rules of the road. We know the airbag going in. I want you to think, what is your portfolio's airbag? Do you have one? Well, I would ask that to the advisor. They'll say diversification. They'll say asset allocation. Then the next question is, okay, I own stocks, I own bonds. I may own a lot of stocks and a lot of bonds, but how is that diversified? Well, it's not diversified at all. I don't even know if that's diversified in the 80s, but it's certainly not diversified in 2025. So when we look at these defined outcome strategies, they are exactly as they say. We know what is going to happen based upon these results. So our protected growth, we know that 5-year annuity, again, I don't care what it's called, 5-year annuity, big deal. I don't care that it's called an annuity. It's offered by an insurance company. Here are the benefits: 100% principal protection. Your worst year is 0, tied to the S&P, 100% tied to the S&P. My ask of you is don't do an annuity unless now there's certain circumstances that you just have to not use an annuity that's not tied to the S&P 500. We had to do one here recently because of the income side of it for this particular client. It just had to be. But 99% of everything that we do is only tied to the S&P 500. Why? Because it's not back tested. It's not some fictitious volatility controlled index that shows crazy returns. I have heard every single pitch known to man, and how these indexes are going to return 10%, 15%, 20%. Yet when they go live in the real world, negative. Think about this. There's a NASDAQ strategy. NASDAQ of all things. NASDAQ, tech, high octane, crazy returns. That has the volatility control, which means there's a bond component. That returned actually 0. In an annuity, 0 when the NASDAQ is up 30, 40%. So my ask for you is, if you're going to do an annuity, 2 things. Has to be short term. Try to keep it to 5 years. Have the investment that doesn't have lifetime income. Have the investment that is tied to the S&P. So that's predefined. We know exactly what's going to happen. If the S&P is down, our return 0. Fine. On the upside, we get the first 10.25% of the upside of the S&P. Not including dividends, so it's price movement. So you get the first 10.25% of the S&P on the upside. That's predefined. Do you know how many people in the Chicago market would love to have a strategy inside their portfolio that they know that is going to give them 100% principal protection based by the issuer, and your worst year is 0, tied to the S&P? You get the first 10.25% of the S&P, and then when you get that gain is locked in, never to go back. Here's why more advisors don't do it, because it pays a commission. The bigger advisors, like we would consider ourselves to be, we really don't want the commission. We would rather have it a fee. We would rather have it just give us a fee, give us a fee, give us a fee. But the bigger advisory firms that are managing $500 million, $1 billion, $5 billion, $10 billion, they'll never do it because they don't want the commission. They would rather have that fee revenue. Well, what I want and how I get paid should have absolutely no bearing on the investment that I'm offering you. And again, we believe in radical transparency. These annuities that advisors say, well, we're not getting paid. Yeah, they are. You're not paying it. Well, yeah, you are. You're paying it in some way, shape, or form. I mean, it may not come out of your account, but the higher annuity commission is, generally, it's not as beneficial to the client. And so many of these annuities I see today pay 7%, pay 10%, pay 14% commission. That 5-year annuity that I told you about, I don't care if you know how much we make, 4.5%. That's what it pays. Do I wish they didn't have to pay us that 4.5% right up front? Of course I do. I would rather have 1%, half, 3/4, 1.25, whatever that is a year. But the reason I tell you that is because, to my knowledge, in the 5-year space, I don't believe that there's an annuity that pays less. And I love that, because you know what that means? They don't need to pay a lot because it's such a good investment to the investor. So predefined, worst case 0, 10.25% of the S&P. How I get paid should have no bearing on what I'm suggesting to an investor to invest in or not. But unfortunately, in this business, it does. And then, you have the bank notes. Again, predefined. We know that we'll get that coupon payment as long as the market's not down 30%. Or I say the market, but it's the indexes the note tracks. There's generally 3. All indexes that are very, very big. But again, that's predefined. So we may have 30%, we may have 40% of your portfolio that we know the rules of the road going in. How comforting would it be for you to have that in a period of market weakness, in a period of 1 year down, 3 year down, 5 year down, or a 10-year period, which many are starting to say that there's only 1% to 2% growth. Now, it'll be 20% this year, negative 10%, the following year, or something like that. But you look back over 10 years, and you've only annualized 1.5%, 2 to 3%. That is an issue. That could be catastrophic for many individuals. So have an open mind to these strategies. These are not cutting edge. There's a good and there's a bad. And our belief is, if you want tax reduction, significant tax reduction. If you want predefined outcome strategies, if you want growth strategies, which I did not talk about, even though I said I was going to talk about it in segment 2, that have historically outperformed the S&P. Again, past performance doesn't mean anything. We have to look at what's going forward. But our growth strategy since 95, again, I'm not managing it. It's third party, 100% third party. So they tell us, they put this out in public. They meet all of the criteria. They're massive. Their performance, almost 2% outperformance annually. It's about 1.7 annually since 95. Doesn't seem like a lot. 1,200%, almost 1,200% cumulative outperformance since 1995 of the S&P. So shine a light on performance. Our Growth Plus strategy, high octane, get after it. 3 to 5%, 7% of your portfolio. Again, they raised significant cash over the last month, significant cash. I think a third of the money at the firm is in cash. I love that. Not crystal ball, mathematics. That strategy since 2015, up almost tenfold. So 100,000 grew to, I think, right over or just under 900,000. S&P slightly over $340,000. Significant outperformance. Again, past performance. It's not indicative of future results. It's not why you invest, but we have to use it as a gauge. Why shouldn't you have 3 to 5%, 3 to 7% of your portfolio in a strategy like that? That is the job of an advisor. Have protected growth, strategies that can do well even if the markets are down. Have growth. The growth has outperformed the S&P. We will show you where they rank versus their peers. Growth Plus, significant outperformance of the S&P. Alternative tax reduction strategies, again, when you bring those 4 strategies to an investor, the uniqueness, I hate to say cutting edge because I don't think it's necessarily cutting edge, but I guess for what everybody else is offering, it is incredibly cutting edge. We're standing alone, and we love that. So 630-492-1912, 630-492-1912 if we can help you out. If not, I'll be back next week. Have a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.